Good morning and thank you for watching Daily Market Insights. Today we're going to start talking about inflation. Over the course of the past 6 months to a year, we've been talking about U.S. Treasury bonds and the cause and effect of U.S. Treasury bonds and the value of the U.S. dollar. As we've talked about over the course of the past few months, we've talked about Jerome Powell and Janet Yellen continuously raising interest rates, but they're raising them incrementally. We are now looking at Treasury bonds sitting at about 3%, and this is in an effort to prevent foreign countries from sending additional Treasury bonds back and the Federal Reserve trying to clear their balance sheet. When this happens, it gives temporary support and stability to the U.S. dollar. And what we've seen since Donald Trump has taken office is the value of the U.S. dollar dropped from about $1.13 all the way down to about 87.69 and then slightly recovered with the increase of U.S. Treasury bonds or the interest rates on U.S. Treasury bonds. Today, me and Mr. Brunson are going to be talking about the cause and effect of interest rates, and we're going to talk to you how to help safeguard against raising interest rates and what has taken place since then. Over the course of the past few weeks, we're starting to see indications from multiple news sources such as Forbes magazine. Forbes magazine 2 weeks ago came out and said they believe gold, because of inflation and interest rates rising, is that we're going to see the value of gold could sit at around $1,600 an ounce by year end. That means we could see about a 23% return for those who get involved in the gold market today. Today, CNBC News came out and they reported that they believe that gold could be at around $1,430 by August. Folks, for anyone that has money in the market sitting anywhere, that means that the value of the US dollar is going to stop or continue to not increase like they're saying that it is, but it means that the value of the US dollar and inflation is fixing to hit us. Mr. Brunson is going to talk a little more about it, and he's also going to talk about some of the new information that we have out for our customers by clicking on the link, and that means you can get a free file right by just clicking on it. You'll get a PDF copy of it right into your email.
Thanks, Coy. So one of the biggest things about inflation is the cause of it. The number one cause of inflation is the printing of more money, excess printing of money. We don't have anything backing it, so the more dollars that we print, the lesser in value they become. It's economics 101. I spoke about this a while back, but under the Obama administration, we saw more money printed in those 8 years than all of the presidents before him combined.
4 trillion, right? Roughly 4 trillion?
About $4.5 trillion. But that's a crazy statistic because we've seen more than $4.5 trillion printed out of thin air, but we haven't seen one lick of inflation yet.
Right.
And so the biggest thing about all of this is if we haven't seen inflation, well, where did that money go? Well, it didn't hit the economy. That's why we haven't seen the inflation yet. Instead, because the banks couldn't loan that money out at near zero interest rates, they wouldn't have made any money on it.
None.
So instead, they turned around and shoved it into the stock market, which has made the market go completely gangbusters over the last 8 or 9 years. And I think the biggest thing that a lot of economists are starting to warn us about is the fact that when this next market correction happens and we go into this next recession, that newly printed money, roughly $4.5 trillion, it's all going to come pouring out of the market into the economy all at once.
I agree with you 100%, Mr. Brunson. And the other thing is that a lot of the customers that we talk to, and me and Mr. Brunson talk to hundreds of thousands of clients on a regular basis. And the common denominator between all of them is that they know that the 2008 recession never really recovered. It was a kick the can down the road type of scenario. And we've seen a huge influx, as Mr. Brunson talked about, of the stock market rising above 26,000 points. And I ask customers on a regular basis is think about what I'm about to ask you. The stock market is sitting at 26,000 points and change going back to January, which is one of the highest levels the stock market has ever seen in history. If that is accurate, how could the U.S. government in March be in a position where they were talking about shutting down the government because they were running out of money? The stock market is supposed to give us an indication that the economy is doing well in the United States. But the flip side of that is you can't have a government within 2 months of the stock market being at a record high being in a position of running out of money. It doesn't work that way. There's something fundamentally wrong. And as Mr. Brunson talked about, we have printed $4 trillion and we're now starting to see the cause and effect of that. And those who are retired with money sitting in 401ks and IRAs and money that's sitting in the stock market, you've noticed that we went through a very volatile period of time from January through March. And now what's happened? It's sitting flat. It's just sitting there. It's not doing anything. This is the calm before the storm. This is like a massive hurricane that has come in off of the Gulf or come off the ocean. It's sitting there, it's hovering, and there's a group of people that are sitting right in the middle of the eye. When that hurricane starts moving, the flooding begins, the rest of the tornadoes and the rest of the aftermath starts hitting everyone else. And that is where you, the consumer, has to be the most cautious. And that's where you're sitting right now. The information Mr. Brunson is going to talk about is going to help you safeguard some of those concerns that we now have. And it's not just us. If you watch the news and you get some of the news articles that are out there, they're going to tell you the same information. The question is when, and we don't know when, but preparation is always going to be half the battle. So that's what we're going to help you with today.
We don't have a crystal ball, but we do have projections. The projections are always based off facts. Every single analyst is coming out of the woodworks right now talking about how we're going to see a recession within the next 12 months. They're all talking about it. Talking about a stock market correction, a recession, but nobody knows exactly when. So what you could do in the meantime is you can click on the link to pick up your actual report. We can send it to you via email and secure your 2018 annual gold global forecast. It basically forecasts what we project that gold will do in the coming months and years. There's a lot of things that are taking place that are going to make the price of gold rise, inflation being the number one key indicator that pushes the price of gold up. So if you want to protect yourself and protect your portfolio, this is the best time to do it. You need to be proactive as opposed to being reactive. It's better to be a year early than one day too late when it comes to these markets these days. So click on the link below to secure your 2018 annual gold report. If you've got any questions or anything on the top or anything that we've talked about today, please comment in the sections below, or you can call the phone number on your screen and you can talk to one of our account executives about what your options are here with the U.S. Money Reserve.
And again, thank you, Mr. Brunson, and thank you for watching Daily Market Insights, and we look forward to seeing you next week.